Good morning, everyone. Hello. Thank you for taking the time to listen to my presentation. My name is Geoffrey Hammond. I'm the founder and manager of Aequantium, LLC, is a managed futures fund operator. So for those of you unfamiliar with the fund industry, there's essentially two types of funds. One is regulated under the SEC called mutual funds, which you're all pretty familiar with. The other are commodity funds, which commodities have a very long history in this country. They go all the way back to the beginning here in New York, which pretty much was established for the purpose of trading commodities. So this disclaimer is required under the Code of Federal Regulations. There are prohibited representations that I'm not allowed to make, in particular that the Commodity Futures Trading Commission or any agency of the federal government has endorsed any of my content. So this is actually required for me to, present any type of promotional material. So the cautionary statement required by the preceding section is the Commodity Futures Trading Commission has not passed upon the merits of participating in this pool, nor has the Commission passed upon the adequacy or accuracy of this disclosure. So the general disclosures required are all here. They're kind of introductory for the presentation. They do have to be included. So sorry for including this stuff. I will go through it pretty quickly. They also have to be done verbatim. There are also National Futures Association disclosures required. The National Futures Association is a self-regulatory organization that polices members like me who run commodity funds. So the National Futures Association has recently issued an interpretive notice for disclosures relating to cryptocurrencies. Hence, Aequantium LLC is a member of the NFA and subject to regulatory oversight and examinations. However, you should be aware the NFA does not have regulatory oversight or authority over underlying or spot virtual currency products or transactions or virtual currency exchanges, custodians, or markets. Pricing blockchain-based debt with futures markets. This is my dream. This is the goal of my fund, is to trade blockchain on futures markets like bonds. Currently, there are financial futures for treasury bonds and other types of debt instruments, but the U.S. Treasury bond and Treasury futures are probably the most well-known and highest volume debt instruments. So my thesis is basically that blockchain can be used as an international settlement mechanism instead of treasury bonds. Because right now, if someone from China and someone from America want to do an international transaction, one of the countries is going to get stuck holding the bag of the other country. There's no third IMF coin or other instrument in order to settle these things. So either China has to hold American debt, or America basically makes everyone else hold their debt. So the CFTC has issued an advisory. I don't know if I can click the link here, but pursuant to a case some of you may be familiar with called CoinFlip, they designated Bitcoin as a commodity in interstate commerce. This is actually really, really good. Everyone in this room should be very happy about the fact the CFTC has taken jurisdiction over Bitcoin, because that means it's legal to trade. Unlike gold between 1933 and 1973 and other commodities which are not legal in interstate commerce. So this will show the jurisdiction of the Commodity Futures Trading Commission comes from the Commodity Exchange Act in 1947. And it defines what commodities in interstate commerce are and transactions in interstate commerce. So if you conduct a transaction with any blockchain, you are actually conducting a transaction in interstate commerce, which is regulated by the federal government and the Commerce Clause and all this other stuff. So this becomes really, really important. When you start looking at the way the government works, they use words like Mad Libs almost. So there is a prohibition on the employment of or attempted employment of manipulative and deceptive devices. If it shall be unlawful for any person directly or indirectly in connection with any swap or contract for sale of any commodity in interstate commerce or contract for the future delivery on or subject to the rules of any registered entity to intentionally or recklessly blah, 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 blah. So I added the same slide, but instead of the word commodity in interstate commerce, or the phrase, I substituted blockchain. There's prohibitions on price manipulations of blockchains, and the basic point is that all of the traditional financial regulations for commodities and interstate commerce apply to blockchain. Now, this is probably the most important criminal law in the United States. This section shows what happens when people have been laundering money instruments under 1956. The most important phrase you'll see is the phrase extraterritorial jurisdiction, which is really, really bad. That means no constitutional rights, no traditional hearings of any kind. The government can do stuff ex parte without even telling you. They can investigate this stuff. That's what extraterritorial jurisdiction means, is essentially the United States government's offshore jurisdiction, like you were on the open waters of the Pacific. So it's an important point to realize that governments use cascading logic, where one little phrase changes in one part of the United States code, and suddenly all these other things are relevant. But in particular, 18 U.S.C. 1956 is an extremely tough criminal law on money laundering and applies to literally any transaction over $10,000. So these are the three financial regimes in this country. You have the CFTC regime, you have the SEC regime. Many, many funds are registered or exempt under one or the other. Usually the traditional method is that if a fund is an SEC fund, they may be exempt under CFTC regulations. Or if they're a CFTC fund, then they have an SEC exemption. For example, my fund is a CFTC regulated fund, but it is exempt under SEC regulations under 3C1 of the Investment Company Act. So now, thank you for letting me get through all the legal stuff. It's important to do legal overviews. Now, the presentation is basically why centralized futures contracts. A futures contract is an exchange-traded contract. It's essentially an agreement for the future delivery of a commodity. They have centralized rules, and the whole point is to price the same commodity in different months. So it's not just Bitcoin today, it's Bitcoin in November, December, January, or sometime in the future. The price today is known, but the price in the future becomes increasingly more speculative the more in the future you go to. Financial markets are early adopters of technology. A lot of the technology that you're familiar with today was actually first paid for by the commodities industry. Things like the telegraph, the telephone, newsprint, calculators, computers. One thing I didn't add onto this list when I prepared it were timestamp machines. We're all familiar with the concept of timestamping. We may not know where it originated was actually from the futures markets. On a trading floor, if you would go there really, really early at like 6 in the morning, you would hear all the timestamp machines just chirping like crickets. But the timestamp machines are used more or less to put a timestamp on the paper records that were used for conducting futures trading up until more or less the late 90s. But, I almost forgot. The last technology the futures market is adopting is blockchain. And it really is a new and exciting technology that can revolutionize the entire financial industry. So the asset classes of futures are traditionally grains from the 1860s when the Chicago Board of Trade opened after the Civil War. And you have livestock futures. Softs are things like orange juice, sugar, cocoa. Energies, metals, currencies, debt, and indices. But blockchain is a new asset class in futures markets. This is a big deal. Nobody's ever come up with a new asset class before. So the fact that blockchain exists as a private currency, more or less, is really a huge development in the space. So the users of futures contracts are primarily exchange-traded funds. Everyone's heard of this. All the money in the world is now in exchange-traded funds, which have taken over the mutual fund industry and made it much easier for people to get exposure to different asset classes. An exchange-traded fund is more or less a fund which buys futures contracts and then sells units of participation in the fund. So you can have an S&P fund, or the gold ETFs are another popular example of exchange-traded funds. But exchange-traded funds are the largest users of futures, and a lot of effort is being put into trying to get a Bitcoin ETF approved by regulators. So other funds are just different random types of funds, probably mostly mutual funds. Commercial commodity hedgers are producers and end users. They are the real intended users of futures markets. So if you have a producer like an agricultural producer, they don't know what the price of soybeans will be at harvest. Instead, they can sell a futures contract, and then they're hedged. So even if the price goes down, they still get the same money. Financial hedgers are the same concept, but usually are more or less hedging interest rate risk. Futures aren't super popular for that anymore. They tend to do more bespoke over-the-counter hedging and use interest rate swaps and other dealer-to-dealer instruments for hedging. Speculators are the final category of futures traders, are people who just want to make money and will usually bet only on an intraday price move in futures markets. So blockchain futures and options were first priced at the Chicago Mercantile Exchange. They have a BTC and now an ETH futures contract, which are cash settled. So what cash settlement means is that at the end of the trading day or the end of the contract expiration, they just call it even at whatever the last price was. So when people sell, they don't have to close their position by buying back, or vice versa. When people buy, they don't have to sell. They just basically settle everything to the last price. The other type of delivery model is used by the Intercontinental Exchange for Bitcoin is physical delivery settlement. So Bakkt is a company trying to do a BTC warehouse for the Intercontinental Exchange. But what it means is that if you buy a Bakkt futures contract and the price goes down, then you can actually get delivery on the Bitcoin in the Bakkt warehouse. The Chicago Mercantile Exchange futures contract won't let you do that. Their business model does not involve deliveries. They prefer just cash settlement hedging. According to Chicago Mercantile Exchange brokers, I used to work there, they think that deliveries are bad because what would happen is that people would trade meat mostly on the Chicago Mercantile Exchange, which has a huge cold storage bill. So when everybody got delivered and the price went down, basically everybody would welch on their storage bill, and the exchange and the clearing firms would be left holding the bag. So that's the real reason the Chicago Mercantile Exchange hates deliveries. Personally, I don't think there is an accurate basis for a futures contract without deliveries. So we'll get into basis in a second. The entities in the futures markets have various public and private stakeholders. The number one is the federal government, which uses the CFTC to regulate futures under the Commodity Exchange Act. They have designated the National Futures Association to be the licensing body, more or less, for futures brokers and dealers. It's what's known as a DSRO, or Designated Self-Regulatory Organization. And they are essentially an arbitrator. So it's like court, but there's no jury, or you can have lawyers, but it's almost better not to. The other types of entities are what's known as designated contract markets, are exchanges. So the NYMEX, the New York Mercantile Exchange, Chicago Board of Trade, these are all designated contract markets. Designated contract markets list the commodity for trading. So the fact that the Merc and the ICE have listed Bitcoin is a really good fact for everybody that's interested in blockchain, because it allows for public pricing. We'll get into that in a second too. The other type of organization that's a public organization is a derivatives clearing organization, which is the exchange clearinghouse. So the exchanges and the clearinghouse are not necessarily the same company. They have a separate company. But the clearinghouse is responsible for margin and makes sure that all the clearing firms have the correct amount of customer segregated net capital, or the positions get liquidated. So the private entities in the futures markets are first and foremost futures commission merchants. FCMs are the clearing firms and usually the brokerage firms as well that actually have the legal right to hold customer funds. So they are the banks of the futures industry. The introducing brokers are similar to FCMs except for the fact that they do not have the right to clear customer funds. So if you have an account with an introducing broker, they will earn the commissions, but the FCM has to basically clear the introducing broker. The other types of regulated entities are commodity pool operators, which are fund managers. That's me. So a commodity pool operator may operate one or more commodity pools of different types. It almost doesn't matter for trading on futures markets. And commodity pools are usually run and traded by a commodity trading advisor. It's similar to an investment advisor under the Investment Advisors Act, and CTAs can bill a management fee. So a broker can only bill ticket charges as the trades are made. A CTA can bill a percentage of assets under management. Commodity pool operators are exempt CTAs, IVs are exempt CPOs and exempt CTAs, and FCMs are essentially exempt from all the other registration categories. So regulated futures contracts are subject to federal licensing and administrative regulation by the CFTC on a designated contract market cleared through non-discriminatory DCOs, and they're cleared by futures commission merchants, which basically issue you the statement which tells you what the open trade equity is, how much the contract made or lost. Futures curve pricing is almost the whole point for futures markets, and this is where it gets a little bit technical and different from the more or less textbook presentation I'm doing, is that in a futures curve, the prices may not always stay the same in futures months. The classic example is old crop versus new crop. So futures markets for agricultural commodities and generally any physical commodities priced in the future would go lower and lower and lower. They call that backwardation. The economic theory behind this is that producers can increase production if prices are higher in the future. So that's actually an important point with Bitcoin futures too. The futures curve represents the future sentiment of cash prices for each subsequent delivery month. As these months approach expiration, so we're in October right now, we're approaching November, the cash market and futures price are supposed to converge. With physical deliveries, it's axiomatic, because if the prices aren't the same, you're going to buy it in one place in the cash market and sell in the futures market, or vice versa. So with cash-settled contracts, sometimes they have convergence problems, is one of the reasons I criticize cash settlement of futures contracts. So the cash futures basis is actually the cash minus futures basis is how they quote futures spreads, is you take the cash price, then you subtract the futures price. Normally, it's negative if the futures contract is higher. So negative basis is contango, positive basis is backwardation. Those terms don't refer to the shape of the curve. You can still have a downward sloping curve or an upward sloping futures curve with backwardation or contango. It refers to the relationship between cash market pricing and futures market pricing. So the most important concept for Bitcoin is what's known as the futures implied repo rate. The implied repo rate is essentially the basis divided by the cash price. So if the futures contract for Bitcoin is trading $45,000 and the futures contract is trading at $50,000, then the basis will be negative $5,000, okay? So the futures contract is higher, and that means the basis will be negative. When you divide that by the cash price, it gives you, well, it's not really the yield to maturity. That's more of a bond concept. I like to use the term yield to expiration. But it would essentially be $5,000 divided by the cash price, $45,000. And then if you take that, divide by the days to expiration, multiply by 365, you can get the annualized repo rate, is what they usually quote. So this is where I was inspired for Bitcoin to trade basically Bitcoin repos in the futures market. I think Bitcoin can replace treasury bonds, government bonds, and all the traditional futures debt by using Bitcoin as an international settlement mechanism with futures. This is essentially what I was saying, is that futures contract pricing is what's known as price discovery. So you can actually know what this price is on a public basis and assign an NAV. If you own a blockchain which doesn't have a futures contract, it's essentially like Warcraft gold. It's not a financial asset. When you do have a futures contract, you can use the futures price to assign an NAV to the blockchain of a fund. So that allows it to become an actual financial asset. Futures markets monetize blockchains. You don't need the central bank. You don't need the treasury. You only need futures markets to adopt a commodity in order to monetize it. The Volcker rule is another really important fact about futures markets. So banks are only allowed to buy what Volcker allows. It's a really important rule, but basically determines what gets bought. Bitcoin is not Volcker compliant, but exchange-traded funds are Volcker compliant. So if there is a Bitcoin ETF, that means banks can buy it, where otherwise they wouldn't be allowed to. It's an important step for BSV as well. If BSV really wants to succeed, it needs a futures contract to be able to price it, and then an ETF in order to be Volcker compliant, if it's not designated as Volcker compliant on its own, which it probably won't be because wheat isn't Volcker compliant, but a wheat ETF would be Volcker compliant. For those of you who don't know, Paul Volcker was a Fed chairman in the late 70s who was more or less the architect of the modern Federal Reserve System. So the Aequantium fund takes investor money and participation, puts it in the futures markets for trading on options, and then issues tokens based on that for participation. Normally, a futures investor will get a PDF statement within 30 days as the requirement. Instead, I would rather have people get tokens on BSV, which symbolize their futures participation. They have NAV updating every day, and they're much, much more secure. Plus, they're verifiable with a block explorer. Tokens are not a new concept. We use this term again. It's actually a really old concept from the financial world. So prior to 1873, silver money was the basis of the American financial system. It was the denominator everything got priced in. Gold was a token. After 1873, with the Coinage Act, it reversed. So gold became primary money. We basically went on the gold standard, and then silver became the token money. All tokens are securities. The terms are interchangeable. So any asset-backed token that holds money or commodities or anything else will need to be registered as a security or exempt under a private placement. There is no way around that. If you do it, you will get busted for money laundering. It is a really, really serious thing. And the government will let you go years until you have more money for them to take. That's how they look at it. I used to work in securities regulation. They're essentially a pirate ship. That's how you have to think of government. So for tokens to be valuable, or for tokens to really work, they have to be more valuable than the actual underlying token unit. So what I mean by that is that I want to issue tokens that are backed by the assets of a fund, like, say, a gold futures contract. The token will only be like a Satoshi, like a postage stamp or a placeholder that allows transfers of the participation unit in the fund, which holds gold at the vault in the COMEX a few blocks away from here. So tokens really need to be backed by a legal value and equity, and it's my dream, more or less, to integrate blockchain into the traditional financial system instead of trying to replace the traditional financial system, which can be updated by blockchain. And the best part about blockchain is that with blockchain, there's no work involved after the execution of a trade. Normally, there's a cycle in financial, it doesn't matter the type of industry, it could be insurance, banking. is that you have execution, clearing, and settlement. So the execution is when people make the trade. Clearing is when all the back office people count all the tickets and punch them into the computer. And then settlement is when it finally appears on the statement of the participants. So for blockchain, the great part about it is it can force the financial system to be honest, where there are no more Bernie Madoffs or other like unscrupulous types of rogue traders and back office people that can steal from their firms because there's no people involved in the clearing and settlement function. This is what will make blockchain a fundamental part of human society for the next 1,000 years, is the fact that you don't need people to work in the back office. So the Aequantium fund holds cash, government securities, and virtual currencies against a portfolio of short option positions. For those of you who don't know what premium collection is, there's a great video on YouTube called The Wheel, which explains how you sell options to collect premium today and then wait for the extrinsic value of the option to decay. The yield is obviously equal to the premium divided by the strike times the quantity. Aequantium also sells a zero coupon debt security payable in 90 days. So it's a short-term instrument designed to create yield for more or less institutional investors. And the fund NAV is basically equal to the assets of the fund minus the financing cost. So you have assets of cash, treasury, security, blockchain units, liabilities of zero coupon debt tokens, options on blockchain futures, and that equals the equity or the limited partnership interest token. BSV tokens will be used for fund participants issued on the tokenized protocol. The BSV token audit trails are verifiable on chain. Aequantium tokens will update NAV daily. That's really a new feature that no other fund is doing. And the tokens can be canceled and replaced. So unlike anonymous, and even though it's immutable, it still needs to be controllable by the issuer of the fund. Because if Kim Jong-un or the Taliban buys one of my tokens, I need to be able to kill the token or I get busted under 1956. So for BSV to start a futures contract, it needs a DCM and a DCO basically to list the futures contract. There need to be delivery rules, either cash settlement or physical delivery, which will allow for establishment of implied repo rates, benchmarks for NAV calculation, and develop a hedge for those holding BSV that want to, or want to hedge their exposure from dollars, more or less. And it also will allow for multi-currency settlement between non-convertible regimes. So if you have BSV futures in Sydney with Australian dollars, in New York with American dollars, and London with pounds, it doesn't matter what country you're in, you can just buy a BSV token, sell the futures, and earn a small rate of return like bonds, but without the issuer risk of a default, which the government is ready to do like tomorrow, if you've been following the Treasury news. So, nope, that's the end of my slides. I hope that I didn't go over the time here. The clock is showing zeros, but I really appreciate everybody taking the time to listen to my presentation and to share my vision of how I want to incorporate blockchain into futures markets. Thank you, everyone, and have a wonderful day.
Bitcoin mining, Bitcoin wallet, blockchain, stablecoins, MetaNet, the evolution of money. Everybody is talking about Bitcoin today, but what exactly is it? Learn the basics from experts. Learn what Bitcoin is, how it works, and why it matters. Bitcoin 101, your ultimate guide to the fundamentals of blockchain.